Hey everyone, Larry Berman here. Yet another very interesting week for chart watchers. Number of economic data points that came out this week. None really more important than inflation expectations, especially as we head towards the Jackson Hole conference at the end of August. So let's take a dive into the chart room and see what we learned. The title of the symposium at Jackson Hole, which is going to be, I think, the 24th to the 26th of August, Structural Shifts in the Global Economy. So what does all that mean? It sees everything that's happening in the world that we've talked about for months and months and months that are pushing and pulling on inflation and markets are going to be talked about. There'll be white papers, there'll be presentations. At the end of the day, what's that rate of inflation that is perfect balance for the economy so it's not too hot, not too cold? That is the focus of this conference. Long-term inflation expectations is really what the Fed is trying to anchor. You can see here by the sentiment survey, University of Michigan, where they asked people what their long-term inflation expectations are, and that got updated on Friday, is basically still contained within that 3% kind of high end. You can see for the better part of a couple of decades, 3 was the high end, 2.5 was kind of the low end. It dipped in recent years below that, certainly around COVID, may have taken a bit of a dip below that, but really has remained anchored. Now, this is inflation expectations as if you were to ask somebody, which they do in the survey, what you think. And a lot of that is what they paid at the gas pump that month and what they paid at the grocery store. So I'm a little bit surprised that this number isn't higher, but basically the mentality has stayed relatively anchored in relationship to the past couple of decades, and that's a big win. When we look at the market-based pricing of similar long-term inflation expectations, the 5-year inflation swap, so this is what the market-based pricing is of inflation 5 years from now for the next 5 years. And still very, very well contained relative to the pre-GFC kind of levels where disinflation was much more of a thing. Now, a lot of people are arguing now we're going to go back to disinflation that we've seen maybe in the last decade, and I would argue against that for a lot of reasons. A lot of what they're going to talk about at the Jackson Hole conference in terms of the shifts in globalization, demographics, all these things that push and pull against aggregate demand and supply. I've been a long-term subscriber to David Rosenberg's research, and normally I reach out to him and say, hey, Dave, can I share some of your wisdom with the crowd? And he always usually says yes. I didn't have a chance to do this today because this hit my desk like an hour ago. And it was a document that he put out in his weekly buffet and highlighted some interesting things here. So when you look at equity risk premium and you look at what is historically the norm based on long-term interest rates and what that implies in terms of valuation for equities, Dave went back and his team went back and did an interesting study. And post-dot-com era, if you looked at that equity risk premium, you would argue that the fair value of the S&P 500 right now is a little over 3,000. If you included the dot-com bubble, you would argue it's closer to 3,500 in either one of those scenarios, with interest rates in the 10-year around 4% where they are today. Obviously, if rates go higher, the valuation is lower. If rates come down, so the 10-year would need to come down to somewhere between 2 and 2.5%, 4,241, 4,535 in each of those scenarios to justify the current valuation in markets. And so what that means is hard landing. Obviously, in a hard landing scenario, you're not going to get the earnings that is currently priced into the market. So looking at it from an earnings perspective, what Dave and his crackpot team suggest is that earnings need to go up to $330 from the current trailing earnings of 226. Ceteris paribus means all other things being equal. So no change in interest rates, earnings have to go up to justify the same valuation. So risk premiums would, if earnings stayed where they are. Now, if we get into a recession, that kind of throws a major curveball to of course, to everything. So a lot of that valuation is a problem for me. And much of the soft landing that's been priced into market is predicated on those long-term interest rates starting to come down significantly from where they are today to justify the valuation. And there's no snowball's chance that that's going to happen until the Fed is sure that rates, that inflation is contained. And I doubt they'll have that confidence any point in the next year. But who knows, they may blink. Getting back into the chart room, TLT, the long-term treasury ETF that we use for trading strategies and trading purposes. So in this past week, blow this up a little bit. Recall last week we were saying we were sort of buyers into this weakness. We were sellers into this strength. We sold a little bit here. We sold a little bit more, 97.10, I believe, somewhere in here. On Friday morning, we bought some back, and I would look to buy more. So as rates rise, as this wall of supply and treasuries push risk premiums higher, I think, there's tradable rallies here. There's tradable positions. This is for short-term traders, right? I'm making $1 or $2 every time I trade the long bond. When it comes to equity markets, if we're right and bond yields are going to grind higher in the next few months with tradable rallies, what's going to happen to equities? So where does the S&P 500 go? We now have a confirmed weekly reversal with another week to the downside. By no means does this say sell, but if we are going to get that seasonal weakness into September and October, at a very minimum, we look for a retracement back to the first Fibonacci, to the rising 200-day average. The rising 200-day average is roughly equivalent to where the 50-day average is on the weekly charts. Not quite the same, but a little bit. And again, you project that out a few months, and the 4,200 area or 420 on the SPY, stands out. And so that's the area I think we're going to come down to at a very minimum, and we'll reevaluate risk at that time. So until we see that, caution, caution, caution is the biggest message there. And in terms of what you buy, you start looking at the rate-sensitive areas that have been underperforming because of rising rates, because eventually, and not imminently, but eventually, those have a lot of value in them as rates then start to fall. So markets being forward-looking, 6 to 12 months, all this stuff is playing out now. So you start to look for stuff that's been underperforming in your portfolios, that is dividend sensitive, interest rate sensitive, for a better return, looking out a couple of years from now versus, the market cap weighted growth names that have been driving indexes. Have a great week, everyone.